Today, we are going to look at 3 stocks that our awesome community has suggested to us, and the reason is a lot of these have gotten within a few percentage points of their 52-week lows. Enphase is number 1, big falls last week. Qualcomm and Caterpillar, so let's get into it. The first thing we're going to look at is Enphase, and Enphase has really even caught my eye because of the fall that it had. And let's look at this on the 1-month chart. This thing is down 32% in the last month, 40% over the last 3 months, 50% over the last 6 months, and year to date down 68%. This is one of those companies that's in the solar world, and this couldn't miss in 2020, early 2021. Let's go into a few things here and see, hey, is it something that I'm interested in right now? Let's find out. It's an $11 billion company. They generate revenue of $2.7 billion, net income of $571 million, and free cash flow over the last 12 months of $844 million. As you've noticed in our other videos, we like to see free cash flow higher than net income, and that's exactly what we're seeing here. Something else that peaks out to me, the return on invested capital, 31% basically. And over the last 12 months, the return on equity is 60.5%. This is actually very surprising to me because in my mind, I put Enphase in that category of, oh, this is a hype stock. But when you really start digging into their financials, it's actually pretty good. Gross profit margins of 45%, profit margins of 21%. Now they're higher, they're growing their profit margins. You can see that their 5-year average is 17.5, and over the last 12 months, it's 21. So I really like to see that. The enterprise value is right in line with market cap. As you've seen in our other videos, we love to see that companies that are really, really close. I mean, if their market cap was higher than the enterprise value, that would be great because with the enterprise value, you're including all of the debt. So this is very, very little debt. Let's pull up the 8 pillars just so I can get a quick glance here. Now, the first thing that I didn't look at, shares outstanding, that is a very, very big number. I'm not totally surprised by it. It's a new company. It's in a growth phase. They're just diluting shareholders. Most shareholders don't understand that, and I'll go into that in a second. But everything else looks pretty good. They can pay off their debt very quickly. As we said, the return on invested capital is really good. Everything is looking pretty decent here. The question to me, honestly, becomes, is this some company that can sustain going into the future? I guess I would look at this, well, I don't like what I'm seeing right here. I'm seeing declining revenue for over the last 2 quarters. You had $726 million in Q1, $711 in Q2, and now $551 million. I would have to go in and say, what exactly is that? What is the reason for that? Let's see if their profit suffered. Their profit, net income it's not that bad. I mean, it's a big drop this quarter, but previous quarter it did not drop as the revenue did. And shares, oh, interesting. Can't say I love this. Over the last 3 quarters, they have bought back shares. Man, this is a tough one for me. Why don't we look at what the analysts are saying real quick before I put this into Stock Analyzer tool? I mean, this is a lot smaller growth than I would expect. I would look at this and say, okay, December of 2023, this year, going to do $5.14. I would expect this number in 2027 to be $15, $16, $17. This is not that much growth for a company that is in truly a growth phase. Now let's look at their revenue. I mean, their revenue is significantly higher than their earnings per share. Well, this is going to be something to take a look at. I want to look at their earnings report to see if there was anything glaring that stood out to me. Did not like the decrease in revenue. Let's see here. And our revenue in Europe decreased approximately 34%. Okay, our revenue in the United States decreased 16%. All right, let's see what I would pay for this company. And before I do this doesn't mean that I'm going to buy it. I don't own it right now. This doesn't mean that I'm going to buy it. It just means maybe I'll get interested at some point. So let's see with revenue growth. Let's go with 10. I'm going to go 10, 15, and 20 because I was going to go 10, 20, and 30. I think that's too much. Profit margins, they are increasing their profit margins. So I'm going to put in here 20, 25, and 30% because they have shown that they can consistently increase that profit year over year. Free cash flow margin, I'm going to put in the same numbers for the sake of ease. PE, let's go with 17, 20, and 23. 17, 20, and 23. On the 23 side, on the highest end, if they're doing 20% revenue growth with profit margins of 30%, I'm going to say, yeah, they're a leader in this industry. And for my return, I'm going to go with 15, 18, and 21%. Let's see what we have here. Current price is $81.75. Okay. So if you believe these numbers that I put in, my assumptions, then yeah, it could be falling into that range. It's still not hitting my low range, and that's where I would err as caution on this kind of company. That's just my personal opinion. If you were to invest today, you would make a 12.5% return over a decade. Okay, let's go to the next one. Qualcomm. Now, Qualcomm had a 52-week low that happened. Where was that 52-week low? It was in May, so May 25th. And recently, that was $101.47. Just last week, it was at $104. So it didn't touch that 52-week low, but our community gets interested when we start nearing these 52-week lows, especially on a monster of a company like Qualcomm. So it's a $133.5 billion company with revenues of about $36 billion. Net income of about $7.23 billion. Free cash flow, again, more free cash flow than net income. We like to see that. Now let's see what else we have. They pay a dividend here. Now they pay a dividend of $3.5 billion. Let's go over here and just see what their cash flow is over the last 5 years. 7.23. It's a very safe dividend. I think that the argument could be made that they don't need to pay the dividend. They can reinvest in themselves. The whole chip market is kind of doing that and growing. They could take that cash and do something else with it, but it's a safe dividend. Investors like that. I'm sure they're not going to rock the boat in that category. Market cap of, like I said, $133.5 billion. And then when you look over here at the enterprise value, that's $151.5 billion. So basically, the difference is the debt. So this company does have a little bit of debt on it. Not terribly surprising, especially if they're in some type of growth mode. Now, I want to go here and I want to look at the quarterly revenue, because when chip stocks skyrocketed, when everyone was staying at home and everyone was buying new devices and this and that, and then we went into the shortage, I want to make sure that that growth wasn't, I want to make sure that it's still growing or it has stabilized and we're not starting to decrease. So let's look over here over the last several quarters. You can see that we have decreased off of these $11.4 billion highs, and quarter over quarter, it's kind of stabilized, but it's kind of falling. I mean, this is not good. So this worries me, looking at a company like Qualcomm. They consistently did $22 to $26 billion pre-COVID. Then COVID came around and they did 33. Then they did 44. Now they're down to about 36. Now where does that go from here? Do we stabilize around 36 or do we drop down to 26 or 23? That's just something that worries me when I look at these chip companies. I'm not sure that the stabilization phase is there yet. So I'm cautious. I am very cautious on these companies. Their ROIC is fantastic. 31.5%. Absolutely fantastic. All right, let's get down here to analyst estimates. I mean, I'm looking at this saying, okay, we just looked at Enphase. You have better growth on earnings per share side with a company like Qualcomm than Enphase. That worries me if I'm comparing the two, even though they're not remotely in the same area. But they're going from $850 to about $1250 over the next 5 years. Revenues, high single digits. Really, what I surprised, what I expected with a company like Qualcomm. Let's see, stock analyzer. Let me see what I did here in the past, because I know I recently did this. This has been a company that I've been briefly interested in. I actually did this on the 2nd of October. So I put in 3, 6, and 9, and I'm comfortable with that. This I'm kind of ignoring. Revenue growth fall of 19%. It's going to skew everything off, and that's why I decided to put these numbers in. I'm not ignoring it saying, hey, this is just an off year. No. I'm not. That's not what I mean. I mean, I'm going to adjust it just to put in my 3, 6, and 9 numbers so I'm not getting carried away. Profit margins of 19, 22, and 25. The same for the free cash flow margin. PEs of 15, 17, and 19. And my return, I wanted a little bit more return, a little bit more comfort here. Margin of safety, 12, 14, and 16. So I click Analyze. Let's see what we have. You can see it's on my watch list for $99. And yeah, so we were getting close. So basically, this thing needs to drop below its 52-week lows for me to get interested. I'm going to put on here, I'm actually going to put 101. And the reason is that's its 52-week low. So that will give me an alert on my phone and email when we get to it. All right, the last company, Caterpillar. Now, why did people like Caterpillar? Because they reported earnings last week, and what happened? They fell 6%. And I want to show something here with Caterpillar. Look at this fall. Big gap down, and it rallied right back up. And I'm going to get into that on the trading side or the chart side in a little bit. But when we get these big falls, don't get completely fooled. Make sure you understand what it is. So I'm going to go over to the 10K. Well, not the 10K, their press release, and just see what they did. Third quarter sales, revenues increased 12%. Now, why am I looking at this? Because we're all talking about the potential of a recession, right? Let's see what these builders are doing. Let's see what construction is doing. Is infrastructure still carrying on? Now, is it from the government bill of infrastructure? Maybe, but let's see if they are still doing well, if they are still growing. Because if they're not, then that's a place of a little bit of concern. Profit per share of $5.45, adjusted $5.52. I know they crushed in that category. Returned $1 billion to shareholders in dividends and share repurchases. Can't say I like that. This is the number that I really wanted to focus on, though. Was there growth? And there was. All right, let's see what else we have. I don't think I've ever looked at Caterpillar, to be honest with you. But this is the great thing about our community. When they see something fall, they bring it to everybody's attention. $123 billion company. The enterprise value is $182. So it's a lot of debt, but with a company like Caterpillar, you kind of expect it, right? Net income. Net income of 6.32. Free cash flow, less. This is our first company today that we've seen less free cash flow than net income. Pretty good margins. Let's see the return on invested capital. 13% over the last 5 years, increasing 18.4% this year. Let's see what else we have. What have they done this year? Year to date, they're up 2%. You can see in the last month, they're down 9.5%. Let's see how their 8 pillars looks. So the debt, no surprise there. I'm not terribly concerned in this space. All I would do is just go to another company and say, okay, is this something that's consistent in this industry? And if so, I wouldn't be terribly upset about it. Shares, can't say I love that. Do they pay a dividend? What is their dividend? 1.86 of free cash. Okay, it's a very safe dividend. And with a company like Caterpillar, I'm not surprised. Let's go over here to Stock Analyzer. I know I've never done this one before, so let's do it. Actually, let's see what the analysts say before we get into this. They are seeing revenue growth of, that's kind of what I was going for, but I'm going to go less because I want to be conservative. Because what if we do go into a recession? People are not going to be building and doing construction at the level that they're doing right now. So I'm going to put in 0, 2, and 4. I understand that's conservative, but let's do worst case scenario. Profit margins of, let's do 8.5, 9.5, and we'll give them 10.5 because they have done it over the last 5 years. Again, I could go through there and just say, I'm going to give them a higher profit margin across the board, but I want to be conservative here just because of the uncertain environment that we're in. PE, well, they're kind of the only game in town, so we'll go 16, 18, and 20. They're the biggest game in town, that's for sure. Everybody knows Caterpillar, 18 and 20. And I'm going to do 12, 14, and 16% desired annual return. $242.50 is the current price. Yeah, this needs to fall a lot, guys. The highest I'm getting is $165 a share, $165.50 from a multiple of earnings side. This just needs to fall and get cheaper for me. And for me, it's one of those companies where I'd be a little apprehensive to invest in something like this in the uncertain times that we're in. Guys, that was just a handful of stocks that our community has given us to look at. We are going to be looking at many, many more. If you want to try the community, click right here. You can try it for free. Come in for a week, give it a shot, and I will see you later this week.